Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm the senior trader for the Forex Super Model, and this is the first in the series of trading psychology videos, and part one is called Check Up from the Neck Up. So let's have a look what we're talking about. So part one, check up from the neck up. Right, so if we're talking about the trading industry as a whole, it's made up of all sorts of players, but on one side you've got the large institutional players, the so-called professionals, so-called smart money, large banks, large hedge funds, etc. Those type of people who employ tens of thousands sometimes of highly trained individuals who have gone through quite rigorous training. They're mostly highly educated, and they're pretty motivated. A lot of them are on high salaries with bonuses, all the rest of it. They work in financial districts across the world, and normally in posh glass offices where you can sort of mirrored glass. They've normally got enormous great trading floors, all the screens, all the data. They're connected to the outside world. There's no real limits to their technology, etc. So that's one side of the game, and then you've got this sort of retail trader type person, the gambit, and they're almost the exact opposite of that. They can be anybody. There's a very low barrier to entry. You can start trading on as little as a couple of £100 or dollars. You open up your account and away you go. Now, and then you've got this sort of like this environment that the retail traders are in, where they're looking at social media, and they're in this sort of propaganda environment where they're being told on all sorts of social media sites what they should be achieving, how they should be achieving, etc., etc. Now the usual story is someone about 21, 22 saying that they've in their third year of trading, you know, and they struggled for at least 3 months. I mean, 3 months. Yeah, really struggled. Now they're consistent and profitable, and then they start wheeling out all the goodies. They've got the mansion, the Range Rover Sport, the Rolex watch. They're all nicely dressed. They spend lots of time down the gym. Their trading hardly takes up any of their time because they're very efficient and they've got a trading plan, and their lifestyle is great. They start talking about their trading journey. They're optimizing. They're using all the buzzwords, and ultimately, as a new retail trader, you're bombarded with all this this sort of propaganda, if you like, and if you actually, you know, stand back and think about what they're telling you, then which most people of course don't, then you know you can do some basic analysis on that really. So I mean, I know from my time in another organisation when we were scooting around early in the mornings in Surrey in the UK, sort of 4 o'clock in the morning, and we'd be seeing some of these professionals, you know, go to work, catch the early morning trains, 4 or 5 o'clock in the morning, and we'd see on a different system in the evening, we'd see the same people come back 7 or 8 o'clock at night, looking like they've been completely ragged out, you know, in the market, in the financial institution that they were at, and then you've got the opposite. You've got these sort of 21, 22-year-olds who are drinking the old tea and having cold showers and telling you that you can get your laptop and you can have this multi-million pound lifestyle off a few hours study. So let's break that down a little bit. So let's assume you're very clever. Let's assume you've got $1,000 account, or pounds, or euros, or whatever you're using. So 1,000. Right, and because you're pretty, you know, you're a good trader, you can stick on 100 a point. You know, because that seems reasonable with $1,000 account. Why not? So there's $100 a point. You're a day trader inevitably, because that's where the action is. That's where you're told to look. So you're looking at, if you're Forex, you're probably looking at getting 30 to 40 points on a trade. So 100 points, that's 3 to 4k, 3 to 4,000. And of course, because you're an excellent trader and you've served your time, you've done your 3 months, then you can knock those trades out on average 3 times a day. So you get 3 of those. So you've got 3 times. So you've got so you're 9k to 12k up per day. Right, and then on a 5-day week, which is what we tend to have in trading. So you've got, let's say, you know, we'll average 10k a day. So in a week we're putting into our account 50k. So 1 week, 50k of profits are going in. 4-week month, 4 times 50, so 200k a month. So 1 month, so 200k. 10 months, 2 mil, so 2.4 mil a year. Sounds reasonable. So a year, what we 2.4, let's not be shy, $2.4 million, pounds, euros per year. So everything's great. So that's what we can achieve. Obviously, if we're an equity day trader, then obviously we wouldn't be messing around with just 30 or 4 points. We'd probably want to get 100 points. So we'd only really need to just do 1 trade. So we'd just swap that out and just do $100 a point, 1 trade. You know, 100 points, £10,000 a day. That type of so it's the same figures. It's just your life would be even easier on equities. So that's what we're looking at. Obviously, that makes perfect sense to the majority of young people coming into the industry, because they're shown, you know, all these people who have achieved it on social media. You know, they're driving up to their mansion in their push car. They've got the big watch on, and away they go. Now of course they're not making any losses because they've served their time, and they're very consistent. They've got the perfect method, etc., etc. Now, obviously that is complete and utter todge. So let's get rid of that before it does my head in anymore. Right. So. That's how the industry, or the low down retail industry, wants you to think. He wants you to think that that is achievable probably within 3 years, because that's the sort of time scale that maximum most people like to even think about. 3 months is what you can do if you go on the right courses and read the right books. After 3 months you should be semi-professional, etc. Now that's one side of it. What anybody who tries that will soon find the reality of it, and that's why people are constantly blowing up their accounts, and even if they're not blowing up their accounts, they're feeling as if they're complete and utter failures because they're not achieving those sorts of returns in that given time span. Now, trading psychology, the figure bandied about, you can look at the ceiling and get the figure for, say, 80% of trading is based on trading psychology. Where that figure comes from, I don't know. I've seen it a lot of times. Let's assume that it's semi-right. I mean, I don't know. We've not got any figures for it, but let's assume. So your thinking and your behaviour accounts for 80% of your performance, rather than your actual application and technical knowledge. That's what they're saying is the other 20%. Also, spookily, it revolves around the 80-20 principle. That's another issue. So trading psychology, a lot of people are peddling that it accounts for 80% of the game, and it may well do and it may well not, but let's start with 80%. So your thinking and your behaviour in the market accounts for a large proportion of how you're going to get on. So that's where we're at with this then. So we've got these two extremes. We've got the professionals who are like getting up with the sparrows, crawling back late at night, completely knackered out, burnt out, earning good money, but definitely earning it. And then you've got the retail crowd who are basically being told that, forget all that, get on a course, gradually get yourself up after 3 or 4 months, and then start coining it in. So you've got these two extremes of reality. And the true reality for the retail trader is obviously, like most things, somewhere in between. Most people are not, even mildly proficient at anything after 3 months, let alone start, bringing in massive amounts of cash. I mean, big hedge funds nowadays in this sort of low yield environment we're in are very chuffed indeed after management fees to get double-digit returns now. So 10% is a very good effort for large hedge funds. So if you're a retail trader and you're starting to grow your account, and you're being told you can grow at 200-300% a day or a week or whatever, then you're way out of line of the reality of it. You may well be able to do that in the short term. Anybody can back the right horse. It's just doing it consistently. So what we're going to try and do is look at the sort of the gap between these two in future parts of this series. The main takeaway of part 1, check up from the neck up, is that you need to start valuing your performance even if you think it's relatively poor. Your performance is probably not relatively poor, it's probably relatively good. If you're a thinking person and you're not just rolling the dice, and you're actually analysing and you're doing some work behind the scenes, then you're actually on the road to becoming a profitable, decent trader, and you need to get away from this this underlying underperformance attitude which is engendered by social media, and it is very damaging. Everybody else is doing better than me. I'm not learning fast enough. Why can't I do it? Am I not taking bigger risks? Am I not putting enough work in? All these thoughts are very damaging to traders when they're starting out. They're damaging to traders in later life, but when you're starting out, they're particularly damaging, and they can lead to ultimately they can lead to depression and account blow up, and just people saying to hell with it, I can't do it, I'm not good enough, and leaving the process, which is a shame, because a lot of people, if they stuck at it in the right way, would become quite proficient traders. So that's really where we're at for the first part of the series. Is I want to leave you on a feeling of, no matter how poor your performance has been in the past, no matter how many accounts you've blown up, no matter how many stupid decisions in your own personal view, I may not think they were stupid, how many stupid decisions you've made, how many times you've got it wrong, how many times you've been on the wrong side of the market. It doesn't. What I'm saying to you is that from in terms of trading process, you're actually doing a hell of a lot better than you think you are, and if you keep going and align yourselves with some of the principles which we're going to develop, you will improve immeasurably, and not only that, you'll generate a tremendous degree of self-sufficiency and mental toughness, which is what you require in the Forex markets. Now, it's all very well for someone like me to go banging on about buy euro dollar or whatever, but you're in charge of your trading account. You are the trader. You are the chief senior trader in your organization. You are the risk manager. You are Professor Code. You do the analysis, and you are, as we say, you are the mad monk running around when you're out of control. So, and you're reporting on yourself, so you're the reporter as well. So all these characters within our organization are in everybody's head and in everybody's trading organization. So we're going to start to sort of strip away all the problems and all the fears and insecurities that go with retail trading over this next series, and in the subsequent parts we're going to start actually building a solid foundation to trading as a retail trader, but trading in a way that is very solid and very potentially rewarding. So thank you very much. Look out for part 2 out shortly. Thank you very much.